Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to hit up Twitter, see what's going on in the Twitter space like I normally do. I will have some more people on as time goes on, so I'll get them lined out, scheduled out, and you'll see a couple of interviews come up. But if you guys need any help with anything, yeah, definitely check out finding-value.com. Become a platinum member, or if you want to follow me on Twitter, it's at finding_finance. Either one of those, you can contact me at one of those areas. So let's look to see what's going on. We got gold and silver are looking incredibly bullish, says momentum analyst Michael Oliver. I listened to it. He said basically all of the green lights are turned on and it's game on for gold and silver. Basically, his opinions are that should be invested and should be riding it to the upside, as all the momentum indicators that he watches and looks for have turned green on different time frames. I agree. I think if you look at ratio analysis and you start looking at GDX versus other ETFs, GDX looks better than, I would say, almost all other ETFs at this time. We could see a very big move, hopefully a very big move in gold and silver. Happy Hawaiian says, buying precious metals is naturally a contrarian position, as they do well when the seeds of economic mismanagement begin to sprout. So we have a lot of contrarians in this space. I'd say it's currently contrarian to think home prices will continue to increase rather than crash. So I want to go over a couple of things. He says, there's so much temptation by FinTwit people to be one who called it, that they can't resist posting doomsday charts on it. I agree we're currently in the boundary zone of affordability, but a housing crash isn't an inevitability. If supply is still massively constrained, if inflation continues to rage, and or if rates come down, then we don't get a home price crash. It's that simple. I'd say we're still far more likely to get nominal price gains, even if it goes back to 5 to 6% a year, still big with leverage. Of course, real estate is always local, as they say. Massive regional differences will continue. Even now, you have the dying parts of the country up 5%, while sunny, low-tax places are up 30%. We might get to where the dying regions decline 5%, while growing areas gain 10%. All right, just saw another one. Time to start making a collection. And these are all the people that they spew fear everywhere. He says, I will make a broad statement. Housing is going to be in big trouble, says Gary. Michael says, oh, U.S. average annual mortgage payment. The 2005-2006 bubble looks almost cute compared with recent developments, and some people really deem real estate as an inflation hedge at the moment. Problem is, your mortgage costs can go up, but you have no homes in inventory. You can't be in a hyper supply bubble like you were in this time frame with no supply. It's that simple. Elf, house prices are down 2% versus last quarter in the Netherlands. The Dutch real estate market is very liquid and highly leveraged, hence pretty reactive to changes in mortgage rates. I expect house prices across Europe and the US to decline a bit in 2022. Here's another one. This is the, what's his name? Reventure Capital or whatever, Reventure Consulting. That's what it is. Much like the GFC in 2008, housing stocks peaked about 12 to 18 months before the collapse of home prices. You can see that in $Z in red, peaked last year in April of 2021. There is now a wide gap that needs to be filled here, which means home prices in blue are coming way down. Gold and silver is what he says. And we'll see. We'll see if that's correct. Adding to the consensus, to be skeptical of U.S. housing, you have to open your eyes to a market ravaged by unprecedented speculation that buries that of prior housing bubble. It's not about one metric. It's about a wicked confluence of factors. Happy Hawaiian, this paper sums up. It says, oh gosh, Dezo is bearish as well. I've been warning about this. If you're wondering why I haven't written about it lately, it's because I've already written about this in the past. The problem is too big and inflation isn't going away. There's no more road to kick the can down. The home buyer mortgage payments are up 35% year over year. Another one, seen a lot of pushback on the idea that real estate prices could come under pressure with rising mortgage rates, hearing every excuse in the book. There's an extreme amount of arrogance and denial about this asset class having any real correction. Fed, job well done. I haven't felt this bearish about housing since 0506 period. Check this out. The portion of disposable income relative to house prices is higher than the housing bubble. And everybody, they mostly go to affordability is what they do. Mortgage payments and affordability is what they've been quoting here a lot. The Fed can kiss the U.S. housing market goodbye. Weekly mortgage applications are down 65%. Market's still hot now, but just a matter of time before it cools. Leading data always ahead of Fed. Liquidity contraction could become severe if they persist. That's his opinion. Wall Street bets on Reddit. The 2022 real estate collapse is going to whatever. The housing market is flipping from liquidity shortage of supply to a liquidity shortage of buyers. Nothing more shocking to the many speculators in a housing bubble than an illiquid market. How extremely difficult depreciating a cash-sucking asset is really worth. Trouble in the real estate market as the 10-year bond hits 3%. They're just on and on and on, guys. Everyone's just making these calls. My God, the 30-year fixed-rate mortgage just hit 5.64%, up that year over year. These are all people that just called housing bubble, housing bubble, housing bubble, all of them. All in 2022, but the housing prices are continuing to go up. Interesting. It says, good news for home builders. The national average cancellation rate dropped for the fourth consecutive month to 9.3%. That brought March 2023 below March 2019's can rate of 10.5%. Mortgage rate buy-downs are helping. So this is the home builder cancellation rate approaching normal. Wait a minute, I thought we were in a bubble here. You know, and here's something. Maybe the recession and the fears, maybe they are behind us. Or maybe we're going through it right now and they will soon be behind us in 6 months or something like that. So this doesn't look that bad to me. I know they were increasing in 2022, but they're obviously declining now. So maybe we should all be bullish on home prices, right? And home builders. I don't know. Here's Uselink. What he posted here is the uranium spot price divided by natural gas, the ratio. He says, looking at this chart, it's either natural gas is going on a tear and outperform heavily, or uranium spot is about to take a massive dive. And given today's 10% gain in nat gas, I go with option one. Nat gas is going to go on a tear and outperform. And this is, remember, uranium over nat gas. So when this goes down, natural gas would outperform uranium. We're at a very cheap level for natural gas against all the other assets. I think nat gas is actually a good spot to be looking if you're a long-term patient investor. So here is Michael Simonson. I know we're doing a lot of real estate here. It says home price reductions are now under 30%. There are plenty of home buyers at these prices for the available inventory. Home prices are not falling. This week at Altos Research, housing market video details. This is the buyer demand keeps up. Price reductions tick down. So let's go over in this thread real quick. It says more buyers and fewer sellers means inventory still isn't climbing. Maybe next week, only 410,000 single-family homes on the market, unchanged from last week. Each week, the inventory comparison with last year improves. And here's our inventory unchanged this week, and you can see it kind of declining over the past few months. It says 18% fewer new listings each week than last year, and 25% of those went into contract within days of listing. Plenty of demand for the existing supply. It makes sense why home prices are stable, even though we'll have significantly fewer transactions this year. It's because the relationship between demand and supply is relatively stable at this time. It says median price of single-family homes in the U.S. is $439,000. That's up a tiny fraction over last week. 2 of 3 Altos price leading indicators are lower than last year. These are ticking up, but the comparisons from last year get worse when prices are still spiking. It says the Altos pending price measurement is the earliest proxy for sales prices. The median price of the single-family homes in contract is $375, unchanged from last week. You can see for the next few months, sales prices will continue to report less than 2022. And then he goes into a video. Low inventory is to keep the house prices steady. And he goes over some other stuff there. Patrick Karam says gold's next FOMO defined target range of $2,600 to $2,900. Targets scale higher as moving averages move up. So this is the gold monthly log chart that we've got here, and we're breaking out to the upside. This looks fantastic for a move higher. It looks so good. This is also your, he usually uses a rate of change. So this is your target peak FOMO, 41% above 36 month. That's that green area up here. And we can move a lot higher here, which we've got a breakout line that we've broken, and we're breaking out on price. So momentum, price, everything looks really good for gold and silver to rocket here. He's got the green box. He also has the peak FOMO of 55% in the yellow box up here. So that's kind of the target range, is up somewhere in that range. And it could happen very quickly. I mean, we'll see. Here's Grady. He says, been posting big evidence for 6 months that something big is brewing for precious metals. Very big picture. We've been in the 70s bull, the 2000s bull, and now we are in a final third bull market. Gold, 10,000 to 15,000 is next. Opportunity of a lifetime still. So this is gold, the 53-year chart, the 3 gold big moves. We got the big move here, the big move here, and this is a cup and handle that's going to break, and we could get another very large move to the upside. He's thinking maybe 10 or 15,000. I think, maybe 8 to 10 grand is probably what I would think, just off the top of my head. And that's kind of an 8 times bull market from about $1,000, which is the bottom here. So we went, 200 up to, well, it's a little over. It's like 300. It's about an 8 times move here. So I think we're going to get about an 8 times move here as well. But that's kind of my gut feel. Sugar. So Uselink was also talking about sugar and silver. It says, this is what I'm saying. Where sugar goes, silver follows. Sugar just did a massive breakout with a lot of momentum. Also look at the 50-year correlation between silver and sugar. So sugar's this guy here. Silver's this bottom one here. You can see that they're very correlated on their movements. And sugar just broke out to the upside, ready to move higher. I think, and I agree with him, that silver's probably going to follow next. Gold's already broken out. We see a lot of positive momentum in precious metals, and sugar is a leader here, breaking on out. So that looks really good. Here's the correlation that he has when you overlay the two, sugar and silver. You can see that they are very well correlated. And sugar, which is in the white line, is already starting to take off. So hopefully that correlation sticks, and hopefully we see silver rocket on up here. And that's what I've got for today, guys. That's what I'm seeing in the markets. I'm pretty bullish on precious metals for sure. I think this is a really good alignment. And if you look at the gold and silver mining companies in relationship to gold and silver, they are still incredibly cheap. This is a huge opportunity for gold and silver mining companies. If we can break that downtrend line that I always talk about on the daily technical analysis, if we can break that and go on up, we could see a vast outperformance of gold and silver mining companies. We're talking, if gold gets anywhere near those numbers, $5,000, $6,000, $7,000, $8,000, something like that. And I'm not saying it's going to stay up there forever. Maybe it does, maybe it doesn't. Depends how much money they create and what the cost curves do. But if we get anything nearer those numbers, the gold and silver mining companies are going to do ballistic things. Because you're talking about, a 5x on the price of gold, or a 4x on the price of gold from here. And if these companies aren't making any money, really, if they're the high cost producer, they're going to go from making no money to a ton of money. And your multiple is what your return will be. It'll be your earnings per share that is going to give you a return. So they're going to, if they have zero earnings right now and you go to anything, that is an infinite return. Obviously, it's not going to be infinite, but in a math sense, if you don't make anything and you then make some money, it's infinitely greater than zero, because you can't divide by zero. So these high cost producers, they could be set up for some just ridiculous looking gains to the upside. Also, if we do get that type of environment, more than likely, you're probably in a banking crisis. You're probably scared, and people are running at the physical metals. If people run at the physical metals and they go scarce, let's say, or they're harder to obtain or get, or the premiums go ridiculous, whatever the reasoning is, you could see money rotate at the gold and silver mining companies, and we could see a vast outperformance of gold and silver mining companies. But They haven't broken out yet. They're still in a downtrend of the XAU to gold ratio, GDX to gold ratio. They're still basing out, or they're still coming on up, but they're still in their base and they haven't broken yet. They haven't broken the big long downtrend lines yet. Hopefully we can break those downtrend lines and they really wake up and start moving. That's what I'm hoping for. I've got good chunks sitting on that bet. So yeah, that's what I'm looking for. That's what I'm hoping for, at least. I know hope doesn't get you anywhere, but we're waiting for that breakout. The ratios are incredibly cheap. And I think the commodities and a lot of individual stocks, if you look at their charts, look incredibly well to break. They've broken to the upside and they look incredibly well to continue and run with very big chart patterns and very big high price targets on logarithmic charts. So that's what I've got for today, guys. Hopefully you enjoyed it. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested in those companies that I'm investing in, at least for gold and silver. And that's all I've got for you guys. So we'll catch you next time. This is Finding Value.